All right, everyone, let's have a look at the short answer portion of exam 1 and the solutions for this. And for this version, this is Marvelous Merchandising. And I'm going to go fairly quickly through this, but you're supposed to prepare journal entries for Marvelous Merchandising. You don't need any explanations. You just need to pop these things in there. So if you've got a copy of this, that'll make it easier. So let's get going here. Go into our short answer questions. First one is May the 8th. We're purchasing inventory on account. So we're buying inventory on account. We know that's going to be accounts payable as a result. And we're going to have some GST that we are going to recover. It's just a matter of how much. And they tell us that it's $1,050 including applicable GST. So if you took the 1,050 and you multiplied it by 5 divided by 105, that will tell you how much the GST is, which would be, in this case, you're going to find that GST is actually $50. So that means that we know we're going to pay them a total, including GST. They tell you in the question, it's $1,050. And so then the amount for inventory is going to be $1,000. So that works out just fine. Second part of the entry is they sold merchandise on the 12th of May to Johnstone store for $3,000 plus applicable GST. So that's fine. So we've got a sale and it's been sold on account. So that means accounts receivable is going to be one of our accounts. And we know that we're going to have sales revenue for sure. And we know we're also going to have GST payable. We're going to collect some GST and we're going to need to send it. So the GST, we know that the sale is $3,000. And of course, that's always a credit. The GST that we are going to charge in that is $3,000 times 5%, which should be $150. And then on accounts receivable, that must be the total, which is the $3,150. So that's the first part of that. We're also told that the cost of the merchandise that was sold was $2,500. So if we look at that, then we know we've got cost of goods sold for $2,500, and we've also got we've got to take that out of inventory because they tell us it's a perpetual inventory system, $2,500. On the 15th, we've got a purchase of office supplies on account, so accounts payable, and I know it's office supplies, and that's an expense. And there's also going to be some GST that we know we've got to calculate it, but it's 5% of $100, which is $5. And we know it's $100, then they tell us in the question, that's how much we've got there. And it's now accounts payable that we have here for $100. So we owe $105 all told. Okay, then on the 28th, we collected the balance from Johnstone store. So that means we got some cash and we would have collected our accounts receivable. And if you look up in the question, and I did on yours, make sure you use the same number. It's $3,150. So the cash we got is $3,150. $3,150. Excellent. So then we look at on June the 3rd, it's part B. It says prepare the journal entry on June the 3rd when Marvelous Merchandising filed their GST return and make the payment or record the refund. So I'm going to put in here, first of all, GST payable. We had one right here for $150. So for sure we should have $150. That was the only one that we had. We had GST recoverable. So that's GST that we paid out. And we debited GST payable to get rid of that GST payable because we're going to pay it. We've got $50 and $5 here, so that's $55 worth of GST recoverable. So the difference is $95, and that's got to come out of the bank. So that's cash. So that's the first question right there. And if you got 16 marks, you got all of these marks here. Oftentimes I had to try and figure out where you're getting your GST payable number from. But generally speaking, if I could follow it here, I gave you the mark here as well. All right, so that's the GST question. On to the capital lease question. Now, the capital lease question is a good one. Not super complicated, but you had to know that you needed to set up the asset. So this is the Goldman Corporation, signed an 8-year capital lease on an office building. There are payments of $7,500 annually, with the first payment due right away. Payments are made on January 1st of each year. Present value of the 7 future lease payments at 10% is $36,510, and the building expected to have a 10-year life. And then the last part there is really the bargain purchase option, confirming that it's a capital lease because they buy it for $1 at the end of the year. So at the signing of the lease, you got to set up the capital lease. So that's A. So in setting up the capital lease, we set up the cash that we pay out, which we know is $7,500, and the liability that we have to pay over time, as they tell us right in the question, is $36,510. Add those things together, and you're going to get, what are you going to get? Going to get $44,010. So that number becomes important because when we do the amortization on for the year, it's amortized over the 10-year life of the building. So that should mean 4401 is the amount of amortization in each year. So it's a debit to expense and a credit to accumulated amortization for a building under capital lease. That was B. And then C, we've got to accrue the interest. And we know that it's 10% interest on this $36,510, which should be $36,551. And so we set up the expense and $36,551, either an interest payable or capital lease liability, your choice, but you need to be consistent with the next one. If you used interest payable, then you needed to debit interest payable here for this amount. Sorry, the interest payable is this number right here. And then the capital lease liability for the principal payment is the difference between that and the $7,500 payment. So you needed all of those. Again, you could lump this all together into the capital lease liability if you were doing that. So that is the capital lease question. On to the payroll question. So payroll question, we've got an employee here who is Sally Lee, works for a company, makes $900 a week for a 40-hour work week and time and a half for anything over 40. And we know that Sally worked 43 hours. So this one should be right here. We should make this 43 hours. So she's 4 hours of overtime. And we know that the rate is $900 an hour times 40 hours. So in that case, you'll find, well, first of all, if you got the regular pay, which was $900, that was great. And then you should have $101.25 there. And so the total should be $1,001.25. The rest just is math after that. So we've got total wages here, $1,001.25. That's the wages expense. This is on January the 31st, and we're accruing it. And we tell you in there that it's an accrual, not a payment. So wages of $1,001.25, using the percentages that they give us for tax, CPP, and EI. You should end up with those numbers, and the difference being salary payable, $732.61, whatever it works out to. Some of you skip the CPP altogether. The Canada Pension Plan exemption doesn't apply, but that doesn't mean that you don't have to calculate CPP. It just means that you don't have to take the $3,500 exemption and share it or use part of it in the calculation. You just had to do the percentage that was given to you. Then you got to do the employee benefit portion, which again is just the same for CPP expense and EI expense or employee benefit expense if you put it all together, and you increase your payable correspondingly. And of course, EI, remember, you need to do 1.4 times. Then you need to pay it all to Revenue Canada on February the 3rd. And so this was February the 3rd. And so then in this case, all you had to do was to clear out the accounts. So here's your employee income tax, you got rid of that. The CPP, here's a couple here, they add up to 99, get rid of that. Get rid of the EI, which was the 1882 and the 2635. Add that all up and you get 344.55. And yeah, so that one not too badly done, but yeah, that's the way you had to look at that. Finally, the partnership income calculation. This one, we have different guys in here. We have TIC, and we have TAC and TOW, and this is our standard format that we use for these guys. We know there's profit of $250,000, and we know that TIC, TAC, and TOW, well, they have different capital accounts. This one has one for $202,000, and in the end, you're going to see that there's a total of $500,000. This one is $182,000, and then this one's for $116,000. So this is more a math exercise. We know that the first thing that they allocate is $100,000, and it's based on the ratio of their opening capital balances. So that's the formula: 202,000 divided by 500, pardon me, times 100K. In that case, you're going to end up here. Just give me half a sec. You're going to end up here with $40,400, I think it is here. And then for this guy, you're going to end up with $36,400. Some of you rounded off too early and made it into even thousands. Shouldn't have done that. Just do the math. Works great. $23,200 for total. And then here, based on service, so it's $60,000 that's to be allocated. So it's, change that to 60 and 60, and then finally here 60. And those proportions, 2, 1, and 3. So there's 2, 6, 1, 6, and 3, 6. So you end up here with 20,000 here and 10,000 here. Whoops, daisy. 10,000 here and 30,000 here. Spreading out, just doing the math. And then we've got 90,000 left over, so everybody gets 30,000. That's fine. Excellent. And so you needed all of that, and you can see the totals down the bottom here. These were the numbers that we were looking for, ultimately 3 marks in here. You got all 3 of these. And then the question asked finally, what did TIC have for an ending capital? You needed to remember the opening capital, whatever the earnings were for TIC. We had drawings of $48,000, which is $4,000 a month times 12 months. Should have ended up at $244,400. So yeah, that's the solutions, and go from there.